C is a computation question and basically employment income question. So we read the question. So the examiner tells us John Musioka is employed as a finance manager by Safari Real Estate Limited. He reported the following details of his income, and that was his wife, for the year ended 31st December 2023. He was entitled to a basic salary of shillings 400,000 per month, and you're being told that pay deducted was 120 per month. Then you're being told that he was entitled to an annual bonus of 120 for during the year. The bonus was for the year 2023 and was however not paid until 2024, February 2024. So being told that the employer provided him with a motor vehicle of 2,600cc that had cost the company 3.2 in the year 2021. The vehicle was valued at 2.5 at the beginning of the year 2023. Number 4, we are being told that his annual mortgage repayment of shillings 820, inclusive of interest of 180, was settled by the employer. Then the loan was obtained from Elite Bank on 1st January 2023 to purchase what we call a residential house. Then the examiner tells us the following deductions, that is additional information 5, were made from the salary during the year. The following deductions were made from his salary during the year. Number 1, we call it subscription to Jenga Golf Club. The figure is 66,000. Then we have contribution to a registered pension scheme. The figure is 180. Then you're being told on additional information 6, he received a gross dividends of shillings 80,000 from his shares in Safari Real Estate Limited, where the withholding tax was paid by the company. Additional information number 7, his wife Janet Musioka is employed by Bright Farmers Cooperative Society as a general manager at a basic salary of 160 per month. She is housed within a cooperative society farm where he contribute 5% of his basic salary as rent. She received a free produce worth 24,000 during the year. Other incomes includes the following. So we have what we call interest income, 10-year infrastructure development bond of 120. Then we have interest from Wema Development Bank Limited, shillings 85,000 net. Then we have what we call the gross farming income of 240, excluding a family consumption of 30,000. So then we're being told that 10, John Musioka and his wife Janet Musioka have been filing separate tax return to the Revenue Authority. So I begin my analysis there. So if you're told that John Musioka and the wife Janet Musioka have been filing separate tax return to Revenue Authority, it means that basically we are going to tax John Musioka and Janet Musioka separately. So then 11, you're being told to ignore computation of what we call affordable housing levy. So required, compute the taxable income for John Musioka and his wife Janet Musioka for the year ended 31st December 2023. And number 2, the tax payable, if any, on income computed in C Roman 1 above. So we begin the analysis, and that is for John Musioka, employed as a finance manager at Safari Real Estate. He reported the following details of income, and that was his wife for the year ended 31st December. So we start with the first one. So being told he was entitled to a basic salary of 400,000 into bracket pay of 120 per month was deducted. So we need to understand that when you talk about a basic salary is a taxable income. So we start with the John Musioka. We say John Musioka. Taxable income. We call it for 2023. So the first taxable income, that is the basic salary, which you've said that is 400,000, that is taxable. However, the payee that we're given in the bracket is what you call a tax credit. We use it to get the net tax payable. We less it on the gross tax to get the net tax payable. So we have the basic salary. So basic salary should be, we have 400,000 per month times 12. So that gives us, when you have our calculator, that should give us 400,000 times 12. So that should be 4.8. That should be 4.8. That should be a figure of 4.8. That should be a figure of 4.8. The next, we're being told, and the payee, just a point to note, that is a tax credit. We are going to less it on the gross tax payable. So it was entitled to an annual bonus of 120 during the year. The bonus for the year 23 was, however, paid until 2024. So still, the bonus is a taxable income, though it was paid, but it's taxable in 2023. So we have a bonus. We have a bonus. The bonus is 120. The bonus is 120. So the bonus is 120. So we're being told that the employer provided him with a motor vehicle that is 2,600 cc that had a cost of 3.2 in the year 2021. The vehicle was valued at 2.5 at the beginning of 2023. Whenever we are calculating what we call it motor vehicle, MVCC, motor vehicle benefit. So when you calculate the motor vehicle benefit, we normally say that 2% times the number of months times the initial cost, not the net book value, but the initial cost. So when you look at this particular question, we have the net book value, which is 2.5, and we had the initial cost of 3.2. So which one do we use? We use the initial cost. So we're going to say motor vehicle benefit is going to be 2% times 12 months, then times the cost, initial cost, which is, the keyword is the initial cost. Initial cost of 3.2. Initial cost of 3.2. You compare with 2,600 cc. What you call 2,600 cc. For this particular one, the examiner is not very specific on a particular vehicle. So if the examiner is not basically very particular, we have three types of vehicle. We have prescribed rate for motor vehicles, that is saloon car, hatchbacks, and estate. Then we have pickups, panel van, and converted, and we have the Land Rover stock Land Cruisers. So if that is not given, we basically use the first one, which is saloon car, hatchbacks, and estate. So 2,600 falls between 2,000 and 3,000, and the value for the whole year is 103,600. So you compare these two and you get the higher. So we get the 2% times 12, then times 3.2. So we have 768. 768. So what is the higher? If you compare 2% times the number of months times the initial cost, we get 768. We look at the motor vehicle CC, we get 103. So the higher should be 768. 768 should be the higher. 768 should be the higher. 768 should be the higher. Then we move to the next. So being told that is mortgage repayment of shillings 820 inclusive of interest of 180 was settled by employer. So the mortgage was obtained from Elite Bank on 1st January 2023 to purchase on residential. So mortgage repayment, it is paid by the employer, so it becomes a benefit, what you call mortgage repayment benefit. Mortgage repayment benefit. And for the mortgage repayment benefit, we have the value as 820. We less the interest because interest is an allowable deduction. So mortgage repayment, if we less that, that should be 820 minus 180. That gives us a figure. Why is it a benefit? It is a benefit because it was paid by the employer. So for the interest, that should be allowable deduction. So we proceed, continue on this end. We continue on that particular end. So then we move to the next. We are being told that the following deductions were made from his salary. Subscription to Jenga Golf Club. Subscription to Jenga Golf Club. Subscription were made from his salary. So when you talk about subscription from Jenga Golf Club, that is not an allowable deduction. However, contribution to a registered pension scheme is an allowable deduction. That is basically an allowable deduction. Then the last one, we are being told that he received a gross dividends of 80,000 from his salary in Safari Real Estate. So when you receive dividends from Safari Real Estate, remember that is what you call a qualifying dividends. The 5% withholding tax is final. However, where the withholding tax was paid by the employer. So withholding tax benefit is now taxable. We call it the withholding tax benefit. We call it the withholding tax benefit. What we call the withholding tax benefit. And that is, we get the 5% from the gross dividends. The 5% from the gross dividends. The 5% from the gross dividends. So 0.05 times 80,000. Why is it a benefit? Because it was paid by the employer. So we get what we call the employment benefit. Employment before we list the allowable. Employment. What we call the employment benefit. So for the employment benefit, we have 4.8. We have 4.8 plus 120 plus 768 plus 640 plus 4,000. So that should be 6,332,000. 6,332,000. So then we say less allowable deductions. Less what you call allowable deductions. Less what you call allowable deductions. So we less the allowable deduction. The first allowable deduction, that is what you call the mortgage interest. So for the mortgage interest, what do you call the actual amount? Actual interest contributed, that was 180. Then the set limit as at 2024, mortgage was 300. So mortgage was basically at 300. So you pick the lower. For the allowable deduction, the taxman is for the taxable benefit, we can identify that the taxman picks the higher. For the items that should reduce your taxable income, the taxman always encourage the taxpayer to pick the lower, which is 180. Then you go to contribution to pension. We have contribution to what we call registered pension. So contribution to registered pension. Contribution to what we call registered pension. So we have actual contribution, what do you call the actual contribution? Actual contribution. In this case, we have it as 180. You compare with 30% of the gross employment. So 30% of gross employment, which is 6,332. Then times 30% of that, 0.3 times 6,332,000. So we have, that should be about 188. We have 600. Then the set limit as a 2024. Set limit as a 24 was 240. So you look at the three and we pick the lower. The lower out of that is 180. We have 180. So we have the net employment net employment income. We have the net employment income. So we have 6,332 minus 360, 180, 180. So we have 5,972,000. So we can say add other taxable income, other taxable income, other taxable income, which in this case we do not have other taxable income for John Musioka. So then we just have the total taxable income, what we call the total taxable income. The total taxable income is basically 5,972,000. So that is the total taxable income. So that is for John. So we go to the wife, who is Janet Musioka. We go to the wife, who is Janet Musioka. So as we read, we analyze Janet Musioka. So we say Janet, they're being taxed separately. So we have the wife called Janet Musioka. Janet Musioka. The wife is basically called Janet Musioka. So we start with additional information number 7. So you just say taxable income, taxable income for 2023. So we are being told that his wife Janet Musioka is employed by Bright Cooperative Society as a general manager at a basic salary of 160 per month. So basic salary is taxable. So we say basic salary. We have the basic salary. That is 160. But we multiply by 12 for the whole year to get the whole year. So 160 times 12. So we have a figure of 1,920,000. So that is a taxable income for the wife, the first. Then we're being told that she is housed within the cooperative farm. When somebody is housed within the farm, that is housing benefit. But we use the trick basically on that particular question is that when an individual is basically housed within the farm, the housing benefit is basically 10% of the employment income. So we have to get other employment income. So we have what we call, she received a farm produce worth 24,000. So that is basically benefit in kind. So farm produce worth 24,000 is benefit in kind, but we don't include it because it's less than 36. So even if you're to put it there, however, we just say benefit in kind. Benefit in kind, that is the 24, but we make a dash. Why? Because it's less than 36. So total employment income for this case, employment income is 1,920,000. So then we get the housing benefit. How do you get the housing? Because the house within the farm, we use 10% of the employment income, so times 1,920,000. Then there's something that the examiner tells us, that she contributes 5% of the basic salary. So we less her own contribution towards the rent, which is 5% times 1,920,000. So once we have that, we simply pick our calculator. We know that 10% is 192. 5% should be 0.05 times 1,920,000. That is 96. So we have 192 minus 96. So the housing benefit is basically 96. So the gross employment income. So the gross employment income. So 1,920,000. So that should be 2,016,000. Do we have allowable deduction? We do not have allowable deduction as per the wife. But we have other incomes. Add other incomes. Say add other income. So on other incomes, that is basically on other incomes, we basically have interest income from a 10-year infrastructure bond. So 10-year infrastructure bond is basically exempted from tax, so that is not included. Then we are also told by the examiner, interest from Wema Development Bank Limited. When an individual receives an interest from a bank, we call it a qualifying interest. The 15% withholding tax is final, so we don't subject that interest from Wema Development Bank. There's always just one thing that students forget, that individuals and a limited company, when a limited company receives interest from a bank, that is non-qualifying. However, when an individual receives interest from bank and insurance company, we call it qualifying, meaning the 15% withholding tax is final. Then lastly, the gross farming income of 240, excluding family consumption. So gross farming is additional taxable. So we have the gross farming income. So the gross farming income is 240. When you're told excluding, you add back the family consumption. So you say plus 30. So you add back that. So that should be 270. We have that as 270. So down here we have the total taxable. What do you have as the total taxable income? We have the total taxable income, and the total taxable income plus 270. The key thing, particularly on this question, even as we solve them, that's 2,286,000. The key thing is on this particular question is basically the entries. These are the awarding marks, not the answers, but this should be what gives the marks. So that is C1. So we go to B, determine the tax payable. Roman 2, C, Roman 2. This was Roman 1. So we wrap this and get the Roman 2. Roman 2. So Roman 2, C Roman 2. So we are told to determine the tax payable. So we have John Musioka. We start with John Musioka. So John Musioka, total taxable income income is equals to 5 million. We have it as 5,972,000. So we go to the tax table. We get to the tax table. So on the tax table, we are being told on that taxable income, remember it's annual. There's per month, but this question was for the whole year. So that is annual. So for annual, if you look at the annual taxable pay, we're being told that the first 288 is 10%. So we have the first 288. The first 288 we tax at 10%. That should be 28,800. So then the next we're being told that between 288 to 388 at 25%. So between that should be 100,000. We tax at 25%. So 25% of 100,000, we know that that should be 25,000. So we're being told that from 388 to 6 million, we tax at 30%. So what is our total taxable income? It doesn't pass that. So we have 5,972,000 minus what we call 388, and that we tax at 30%. We tax at 30%. So we're going to have 5,972,000 minus 388. So we have 5,584,000 times 0.3. So that should be 1,675,200. With that, we get what we call the gross tax. We get what we call the gross tax. So the gross tax, we add plus 28,800 plus 25. So we're having 1,729,000. Then on this, we less what we call less less what you call the tax credit. So the tax credit that we have, the first one is the payee. We have the payee. For the tax credit, we have the first one, which is payee, pay as you earn. So we have payee. Payee was 120 times 12. 120 times 12. That was per month. 120 times 12. So 120 times 12. So that should be payee 40. We'll less that. And then we have what you call personal relief. We have what you call the personal relief entitled to resident. Personal relief, that should be 28,800. 28,800 for the personal relief. That is 28,800. We do not have any withholding tax. We do not have, because those are the incomes were even for the dividends that was qualifying. So there's not any. There's not insurance. So we do not have any. So get the net tax payable. What do you call the net tax payable? The net tax payable. So we have 1729,000 minus 1440, then minus 28,800. So that should be a figure of 260,200. And the layer and emphasis. The emphasis is not on the answer. The emphasis is on the entries. So we have the wife that is called Janet Musioka. We have the wife who is called Janet Musioka. The wife who is called Janet Musioka. Total taxable income. We have the total taxable income. We have the total taxable income. The figure is 2,286,000. 2,286,000. 2,286,000. So remember, that is also annual. The figure is also an annual figure. We are being told that the first 288 again, the first 288, we tax at 10%. So 10%, that should be 28,800. So being told that between 288 to 388, we tax at 25%. So that should be 100,000 times 25%. That should be 25,000. That should be 25,000. So we're being told that between that, from 388 to 6 million, we tax at 30%. What is our all taxable income? So we have 2,286,000 minus 388. Then you get that difference, you multiply by 30%. So once we have that, we have 2,286,000 minus 388. So we have 1 million, 2 million. We have 2,286,000 minus 388. So that is 1,898,000 times 30%. So we have a figure of about 569,400. So we have the gross tax. That should be plus the figure we get, that plus 25. So we have the gross tax to be 623,200. So we were not given the pay. So we only have less tax credit. Less the tax credit, which is personal, what you call personal relief. So personal relief in this is 28,800. We were not. So then we have the tax payable. So minus 28,800. So that should give us about a figure of 594,400. And the key thing is on the particular entries. These entries, that's what constitute. Like for this particular question, we can just, for the sake of learners, determine the tax payable. If it's 4, we need to get 2 for this, 2 for this. So any 4 entries times a half, that should give you 2 marks. Any 4 entries times a half should also give you 2 marks. Even if you have 31.5, that should be able to be rounded to 2. So if you have 3 to 4 entries, then you have a whole mark for this. You also have a whole mark for that. So that's how we basically tackle question 3, April 2024.